Welcome back to Mortgagenomics Canada. I'm your host, Marco Gello. I'm a licensed mortgage broker in both British Columbia and Alberta, originally from Calgary, but now in North Vancouver since 2011. If you're in either province and need mortgage advice or services, I'm your guy. Call or text me directly at 604-800-9593, 604-800-9593. One application, one credit check, and access to Canada's top lenders. Today, I'm going to talk about Canada's mortgage renewal cliff. It's in progress, it's happening, and I want to discuss strategies how to reduce payment shock as mortgage holders graduate from the historic low rate environment of the past to today's new norm. Thousands of Canadian homeowners are approaching what's being called the renewal cliff, with nearly 60% of mortgages set to renew throughout the remainder of 2025 and 2026. Many of these borrowers first locked in rates between 1 to 2% in the years 2020 to 2021 and are now facing renewal terms closer to 4.5% and pushing upwards up to 5%. And this translating to payment increases of roughly 15 to 20%. For households already stretched by rising living costs, this payment shock will feel overwhelming for sure. The good news is there are ways to soften the blow, from extending amortization periods or making strategic lump sum prepayments, to even considering a switch once again to a variable rate mortgage, if they do in fact drop lower like they are talking about these days. So once again, we are seeing a lot of 1 to 2% mortgages come due and renewing into the 4.5% to 5% range, as I mentioned. And as you can imagine, this does end up having a meaningful effect on monthly budgets. So for example, a $500,000 mortgage at 2% carries a monthly payment of about $2,100. Renewing at 4.75% bumps that up to roughly $2,500. So this is a difference of $400 a month. For some, that may be manageable, but for others, it could be a huge adjustment. So let's take a look at a few strategies on how to reduce this payment shock, or in some instances, eliminate it altogether. The first strategy is the most popular and likely the most impactful, and that is extending the amortization period. Stretching out the amortization reduces monthly payments by spreading the balance over more years. While this increases long-term interest costs, it does provide much needed short-term relief. For example, imagine a $500,000 mortgage coming due with 20 years remaining at the amortization schedule. At your original, let's say 1.89% interest rate, your monthly payment was about $2,000. So now, fast forward 5 years later, renewing at 4.5%, with that same year, 20-year amortization, would raise that payment to roughly $3,100. So that's a substantial $1,100 increase. By extending the amortization to 30 years instead, the payment drops to about $2,500. So far more manageable. You go from a $1,100 bump to $500. Importantly, you retain the flexibility to increase payments or make lump sum contributions within allowable limits, giving you that chance to catch up to your original amortization schedule when it suits your financial situation down the road. Another remedy to bring down that payment, but this method not as popular, is making lump sum payments. If you have some extra cash kicking around, even a modest amount can bring down the principal and help offset the impact of higher interest rates. So for example, a $20,000 lump sum on a $500,000 balance can save about $100 per month at renewal. So like I said, this one isn't hugely popular and life-altering, as it's more of a, have your cake and eat it kind of act. Like if you already have a substantial amount of cash kicking around, you are likely in a position of power to begin with, rather than, distress. So it's not really a relief type of outcome, but more so how I can pay down my mortgage quicker scenario. The next one here, and I hesitate when bringing up this next option because of what we recently came out of with the trajectory rise of variable rate mortgages from the low 2% range to as high as over 7% not long ago. But many are also starting to have a second or more serious look at variable rate term mortgages again. Today, Canada's prime rate sits at 4.95%. With a strong discount, for example, prime minus 0.7, if you can get that, borrowers could start at 4.25% today and potentially see their rate drop toward 3.5% if economist forecasts of another 75 basis points in cuts, over the next year proves accurate, if that comes into play, because that's what they are saying right now. On a $500,000 mortgage with 20 years remaining, that means a payment of about $2,000 today, with room to decrease further if rates continue to fall, prime rate, compared to the $3,100 monthly payment I used for the 5-year fixed example just a few seconds ago. And if you then double down that variable rate term with an extended amortization, the monthly payment can drop even more, offering even that much more breathing room for you. And lastly, one that many rarely consider, investigating whether your mortgage is default insured. Your mortgage is default insured, by the way, if you purchased your home with less than 20% and you haven't increased the mortgage principal since. Okay, so if your mortgage is default insured, when we say default insured in Canada, it's often associated with the term CMHC, but there's there's three insurers in the marketplace in Canada right now, so it could be any one of three. If your mortgage is default insured, you get to maintain this status during your renewal. Okay, so this is kind of like a built-in discount badge. As insured mortgages often qualify for lower interest rates. Okay, so to add to this, it's important to know that if your mortgage is default insured and you are eligible for lower insured rates, your eligibility becomes void if you have to make any changes to the mortgage. So this could be either increasing your mortgage amount, like you want to seek extra funds to pay off some debt, therefore you become a refinance, or if you add or remove existing title holders to the mortgage, right? But otherwise, it's a nice little perk to be aware of and seek it out and see if your mortgage is insured. And that's basically it. These are essentially the main strategies for dealing with any payment shock issues you may potentially encounter. So again, number one, extending your amortization. Number two, making a lump sum payment. Number three, considering a variable rate term mortgage. And number four, finding out if your mortgage is default insured, and of course, then taking advantage of it. Working through these possibilities often requires more than just a conversation with your bank. Branch representatives at banks will rarely volunteer alternative strategies unless you ask the right questions. And some of them outright simply are not aware or don't know any better. And the same could be said of mortgage brokers too. And that's where the experience level of a mortgage broker becomes invaluable. An experienced mortgage broker acts as your quarterback, guide you through the full range of options, negotiating on your behalf, and ensuring you have a clear picture of all possible outcomes, because not all lenders have the same renewal options. So it's important to have access to multiple lenders so you can seek out and compare the various products, from minimizing payments to selecting the right term and amortization. Skilled mortgage broker with plenty of experience provides that level of expertise and advocacy needed to align your mortgage with your personal financial goals. The upcoming renewal cycle is definitely shaping up to be one of the most challenging Canadian homeowners have faced in decades. But with preparation and the right strategies, you can meaningfully reduce the impact of a potential payment shock. Whether it's extending your amortization, making that extra principal payment, switching products, or negotiating more aggressively with your bank, the key is to plan ahead. Reach out to your mortgage broker at least 6 months before maturity. 6 months before maturity. This window provides enough time to refresh your application and supporting documents, ultimately positioning you at the front of the line and ready to act on market opportunities in real time. Okay, that's all I got for today. Call or text me anytime if you have any mortgage questions at all, especially if you are in British Columbia or Alberta, as I am licensed to service these specific provinces, and especially if you are from Vancouver or Calgary, as I am very familiar with these markets. Come to me for all your mortgage needs. Call or text me at 604-800-9593, or you can get me on WhatsApp, or just go ahead and link up to my website, homefinancingsolutions.ca, where you'll find my complete catalog of past blogs and podcast episodes. And one more thing, check out my award-winning mortgage app. It's embedded somewhere in the notes or profile section from where you are listening to or viewing this. This thing is amazing. It comes equipped with tons of calculators, market interest rates, and every other thing you can imagine. It even enables you to do a snap pre-qualification on yourself. You got to check it out. Give it a try. Thank you again for tuning into Mortgageonomics Canada. Stay well, everyone. Talk again soon.